The Pacific fog hadn't even lifted when Chinese port officials boarded the U.S. freighter Liberty Star, a ship stacked with Texas semiconductors bound for Los Angeles. They didn't speak. They just handed over a single sheet 400 yuan per ton, effective immediately. Within the hour, shipping feeds across Bloomberg and Reuters lit up with the same headline. China just taxed America's ships. Half a world away, Trump tore through briefing papers in the Oval Office and shouted one order that would shake the markets. Double it. By sunrise, global trade wasn't moving. It was breaking. Half a world away, President Donald Trump leans over the Resolute desk, a sheet of tariffs spread before him like a war map. According to Bloomberg, the new order reinstates 100% duties on $450 billion worth of Chinese imports beginning November 1st, alongside sweeping controls on chip design software and strategic materials. The White House statement calls it the correction of 20 years of imbalance. Markets react instantly. The S&P 500 falls 2.7% in early trading. The Nasdaq more than 5%. The Wall Street Journal reports over $1.5 trillion in equity value erased within hours. Cargo brokers in Singapore track the fallout on their terminals. It's the most aggressive port retaliation in modern shipping, says Eric Broekhuizen of Poten & Partners, quoted by Reuters. Beijing's regulation reaches beyond flags. Any ship with more than 25% U.S. ownership now qualifies for the new fee. That definition ropes in tankers, LNG carriers, and container giants registered in Panama but financed through New York. At Los Angeles Port, the first instructions arrived from Washington U.S.-flagged vessels are to continue operations but prepare for reciprocal disruptions. Dock managers tell Bloomberg they've received contingency routes through Busan and Singapore to bypass Chinese ports. The rerouting adds up to 19% to shipping times and could raise freight costs globally by $3 billion in the next quarter, according to Clarkson Research. The rare earth chain is the second front. Reuters confirms Beijing added 5 new elements, yttrium, terbium, holmium, erbium, and thulium, to its restricted export list. U.S. manufacturers using these materials must now seek Chinese approval before exporting finished goods. Analysts at Goldman Sachs estimate China controls 92% of processed rare earth output, producing 270,000 metric tons last year compared with America's 40,000. Trump's team counters with a domestic mining push. The Financial Times reports the Department of Energy pledged $36 million for stakes in Alaska's Trilogy Metals, aiming to accelerate extraction of cobalt and copper. But production costs are 5 times China's, and imported mining equipment now faces its own tariffs. That means higher downstream prices for U.S. automakers and chip plants, a paradox of protectionism the administration refuses to acknowledge publicly. By Thursday afternoon, soybean futures drop 8%. Chinese buyers shift new orders to Brazil, confirming data first published by Reuters showing a 23% year-on-year collapse in U.S. agricultural exports to China. Farm groups plead for relief, and Trump's advisors weigh emergency subsidies. Treasury Secretary Scott Bessent warns internally that tariffs are taxation in disguise. A line leaked to the Wall Street Journal later that evening. Then the reversal begins. USTR quietly revises port rules, cutting penalties on foreign-built car carriers from $150 to $46 per ton. Reuters notes the change came hours after intense lobbying from U.S. ship owners and Gulf energy exporters. The same memo reinstates exemptions for LNG and ethane carriers, vessels critical to American energy exports. Inside Beijing, the Ministry of Commerce interprets it as weakness. Within minutes of the announcement, Bloomberg reports that China will escalate the port fee yearly until 2028, reaching 1,120 yuan per ton, roughly $156 at today's rate. For a 100,000-ton cargo ship, that's over $10 million per docking. U.S. maritime operators warn they may change registries to avoid classification as American. Let's pause, because this wasn't supposed to happen. Not yet. The United States sought leverage. Instead, it exposed dependence. According to Reuters, North America accounts for less than 5% of global ship ownership. The United States built only 0.1% of commercial vessels last year. China's shipyards control over 50% of global output, up from 5% in 1999. When Beijing taxes the seas, it's taxing lanes the United States barely sails. At the Commerce Department, internal models obtained by Bloomberg project consumer prices rising 0.6% within 2 months as freight surcharges filter into imports. Goldman Sachs calculates Americans absorb roughly 70% of tariff costs, a finding the White House denies publicly. The president insists on social media that China pays the tariffs. But in stores from Detroit to Dallas, prices tell another story. The IMF's latest trade monitor shows Chinese exports to the United States down 30% year-on-year, but total exports worldwide rising 8%. Diversification cushions Beijing's losses. American imports, meanwhile, shift to intermediary countries like Vietnam and Mexico, raising costs without reducing dependence. In Alaska, Trilogy Metals engineers report equipment delays due to customs backlogs. Their suppliers cite new United States import checks on steel components. A spokesperson tells FT the mine cannot reach full operation for at least 18 months. On Wall Street, Morgan Stanley models a scenario where tariffs hit 100% and the dollar strengthens further, crushing export competitiveness. Analysts warn of a tariff inflation spiral. Beijing, reading those same reports, moves ahead with a new layer of inspection orders for United States goods entering Chinese ports. Documents seen by Reuters outline longer clearance times and duplicated data entries, non-tariff barriers disguised as routine checks. In Washington, the president's advisors argue over retaliation. One suggests matching port fees, dollar for dollar. Another recommends a summit with Xi Jinping at the upcoming Korea meeting. Reuters quotes a senior official saying, "We might still talk, but not on their terms." Across the Pacific, freight insurers recalculate risks. Lloyd's of London raises premiums on American vessels by 22%. Bloomberg notes that charter rates for United States-linked tankers jumped 31% in a single session. The next morning, the Financial Times reveals Beijing's deeper motive, reducing U.S. import exposure altogether. By taxing American ships, China forces its own firms to reroute trade through third-party carriers, effectively cutting direct links. It's a slow decoupling masked as retaliation. In Houston, energy executives fear losing their Asian buyers. Every LNG cargo that moves through a U.S. flag becomes a liability, one tells Reuters. Contracts are quietly rewritten to shift deliveries onto neutral registries. Meanwhile, the Wall Street Journal reports that 11 million gross tons of U.S.-owned shipping are now exposed to Chinese levies. Panama's maritime registry confirms a surge in reflagging requests. The president appears briefly on camera. "We're not backing down," he says. But minutes later, Bloomberg breaks another headline. USTR is reviewing additional exemptions for agricultural goods and pharmaceuticals. The so-called hard line is bending in real time. At sea, the Pacific Meridian receives word that payment must clear before departure. Its operator wires the equivalent of $9.8 million to Shanghai Port Authority. Crew members watch as cranes unload containers labeled Texas Instruments, Caterpillar, and 3M. In Beijing, officials celebrate the first successful collection of the U.S. vessel levy. State media describes it as a balanced application of fairness. On Capitol Hill, senators debate whether to subsidize shipbuilding. Reuters reports an emergency bill proposing tax credits for domestic shipyards and a maritime security fund of $2 billion. Yet even if approved, it will take years before the U.S. can compete with China's scale. By Friday evening, Bloomberg tracks another shift. U.S. consumer confidence dips to a 6-month low as prices climb and volatility shakes markets. Economists warn that any sustained freight disruption could add 0.3% to core inflation. Meanwhile, China's rare earth export controls ripple through defense contractors. Lockheed Martin confirms cost increases on F-35 components due to supply shortages. The Financial Times cites internal memos predicting further production delays. At a shipping conference in Singapore, analysts discuss whether these escalating port fees signal the start of a maritime Cold War. It's not about ships, one strategist tells Reuters. It's about control of arteries. In Washington, aides quietly draft a briefing note titled Policy Reassessment. It acknowledges that the 100% tariff plan may require staggered implementation. The line between resolve and retreat blurs. By nightfall, the Pacific Meridian's engines hum again. Its captain logs departure, the new taxes recorded as operational adjustment. The president tweets that talks with Xi Jinping may still happen if terms are fair. Bloomberg interprets it as a signal of back-channel negotiation. Beijing remains silent. At dawn, satellite data from Reuters shows a dozen United States-linked vessels idling outside Chinese ports, waiting for clearance under the new tax regime. The global map of trade begins to redraw itself, and as another freighter lowers its American flag to re-register abroad, a question hangs over the Pacific. How long can a nation claim command of the seas when its ships must pay another power just to sail them? Beijing isn't stopping at the ports. Late Friday night, Bloomberg confirmed China is drafting a rule that would require all foreign-built ships docking in its territory to disclose their full shareholder structure, a move analysts say could expose hidden United States stakes across global fleets. At the same time, Reuters reports that Chinese banks have begun offering low-interest loans to domestic ship owners who switch from United States-affiliated insurers to Chinese ones, effectively pulling maritime finance into the sanctions arena. In Washington, the Commerce Department issued emergency import waivers for lithium-ion battery components from South Korea and Indonesia, an attempt to offset China's widening export controls. But FT notes that those countries depend on Chinese precursor materials, meaning the workaround could fail within months. Shipping data compiled by Vortexa shows United States-linked cargo throughput through Chinese ports plunged 47% in the first 72 hours after the new levy took effect. Tanker operators now warn of a cascading shock to global energy logistics as refineries scramble to reroute crude shipments through costlier Southeast Asian terminals. Meanwhile, the Wall Street Journal reveals Beijing's customs ministry has quietly doubled inspections of American tech hardware entering China, targeting servers and telecommunications components, a signal that port taxes may be just the surface layer of retaliation. And in a late-night address, Trump hinted at secondary tariffs on European and Korean shipbuilders accused of acting as proxies for Chinese freight. That threat alone sent global shipping stocks tumbling another 9% before Asian markets even opened. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.